We know there are many choices in internet radio, and the staff and host of LA Talk Live would like to thank you for choosing the internet's hottest destination for the most eclectic sound and invigorating talk. This is LA Talk Live. We are more than just talk.
This is the Mortgage Show with Burness Herron. LA Talk Live, we're more than just talk. Reality radio, handcrafted for your listening pleasure. Thank you for joining us again. This is the official launch show. Last week was the pilot show. It's hot out there. I mean, summertime is here. I tell you about that. Nice 4 or 5 traffic. It's Independence Day. Pending. Hope everyone's going to have a great 4th of July. We're going to name this show Stars and Stripes. Okay. For all my listeners and everyone out there, I want you to take a quick look at the new Malibu funding sign. Go ahead and give us a call at 888-713-2929. All calls will be addressed at the end of the show. And the way we're going to conduct that is, last week, Federal Reserve, Bill Bernanke, he went ahead and gave us all that news, right? So the uncertainty is pretty much, I don't know if it's stagnant or if it's still moving, whatever the situation may be, but for sure interest rates are going up, right? No one has a crystal ball. Either we're going to stay at par, we're going to stay where we're at, we're going to go down, we're going to go up. Only thing I can say is call Malibu Funding as soon as possible. Take advantage of the historic low rates. This is something that everyone needs to do. There's still millions of homeowners out there that needs help. To recap, what we spoke about last week was HARP, Fannie Mae, Freddie Mac, things of that nature for homeowners that are responsible, that continue to pay their mortgage payment on time, but for whatever reason, they didn't have any equity, no appraisals acquired. Remember, if you're 4.75% or above, then there's still time for you to capitalize on the market. It's still going to make sense. If the rates go down, we'll go ahead and refinance you again. Now, the majority of all our loans are going to be a no-cost loan at no obligation to you. We'll go ahead and get your firm proposal by a licensed agent, tell you exactly what we could do for you, give you a quick snapshot, okay? Now, coming up today, we have 2 guest spots, all right? Little different today with the format. They're actually going to be calling in. And when they call in, I have one reputable rep. I believe her name is Wendy Van Wessel. She's with Stearns Mortgage. She's been around for quite some time. She's a veteran in our industry, and I'm very excited to have her on pending in a couple of moments. She's going to be talking to us about FHA, Federal Housing Administration products. There's a lot of information out there on the new mortgage insurance premiums, the upfront MI and the monthly MI. She's going to break that all down to you and give you the science on that in layman's terms, okay? We do all the diligence for you, so all you have to really do is make a decision, and an educated decision. The best way to make the decision, although, is to get the facts, and that's why we're here. We're here to bring the facts. Second half, we're going to have a guest spot by a gentleman by the name of Luke Manke. Luke Manke, also with Malibu Funding. He's part of this collaboration. Highly respected in the industry, broker. He's very knowledgeable. And we're going to talk about conventional loans with that gentleman and break that down and give you all the particulars in regards to that. Okay? So it's going to be a really nice show coming up for you. And remember, every Tuesday at 3 p.m. Pacific, you can catch me here live at LA Talk Live, okay? Also, we have other affiliates, which is Live 365, I believe, iTunes Radio R&B, and also Ustream TV. You could always, tune in and watch the visual aspect as well. Well, that's it for now. Like I said, summer is officially here, and it's hot. The market is hot, and we're ready to get going, okay? So remember, this is reality radio, handcrafted for your listening pleasure. My name is Burness Herron. You tune in to The Mortgage Show, LA Talk Live. Hey, we're more than just talk.
Journey Sisters is an organization that embodies and captivates women from all walks of life. Our membership includes 44 women that are constantly growing in the areas of personal development and community involvement. Monthly, we offer free leadership classes at McKay's Restaurant. Journey aims to inform women in the areas of heart disease and HIV and AIDS. Experience the journey now by logging into www.journeymosaicinc.com. Toll free 888-906-5519. Journey with no excuses.
Walk, run, climb, play. Solgar number 7 can help. Feel the difference for yourself. Solgar number 7 actually shows improvement in joint comfort within 7 days. Now you can start to get back on track fast and pursue the activities you love. Solgar number 7 is a breakthrough in joint care with no glucosamine and no chondroitin. The advanced bioactives in Solgar number 7 help to increase flexibility, mobility, range of motion, and actually shows improvement within just 7 days. One capsule, once a day, is all you need. When stiff joints occasionally say no, Solgar number 7 says yes. Visit Solgar.com and learn more about Solgar number 7 today. That's www.solgar.com, www.solgar.com. Solgar number 7, official sponsors of Here's to Your Health with Josh Lane and LA Talk Live.
Hi, this is Burness Heron inviting you to join me every Tuesday at 3 p.m. Pacific Standard Time for our all-new show, The Mortgage Show. Join us as we discuss exclusive new products and programs through government and conventional financing. No mortgage-related topics are spared. Come with me through this journey of informative, stimulating conversation, giving you the facts, clarity, and insight you deserve. You never heard a mortgage show like this before. You'll be enlightened, educated at the same time. This is for the community, for the nation, for everyone. As the industry evolves, we evolve. So don't forget to tune into The Mortgage Show, 3 p.m. Pacific Standard Time, exclusively on latalklive.com. You can also catch us on iTunes Radio R&B or just watch us on Ustream TV, reality radio, handcrafted for your listening pleasure. This is LA Talk Live, and we're more than just talk. Welcome back to The Mortgage Show every Tuesday afternoon, sunny Southern California. Here at LA Talk Live, I'm your host, Burness Heron. Glad you could be with us. It's a crazy day in the sports world. Dwight Howard, for all the sports fans, maybe he'll stay with the Lakers, maybe not. But today, it's all about mortgages. Give us a call, toll free, 888-713-2229, 888-713-2229, 30-year fix, 4.25%. No cost loans are pending. Obviously, market shifts all the time, so subject to change with terms and everything of that nature due to the market validity. But go ahead and call Malibu Funding after the show. Make sure you tune in, talk to a licensed rep. Maybe he or she could help you out and accommodate you for a loan. Back on gears now. We're going to be speaking with Wendy Van Wessel. Wendy, you there?
I'm here.
Hey, Wendy.
Hello, Bert.
Hey, nice for you to be here. Thank you so much. Wendy, for all the listeners out there, as I stated, she's with Stearns Wholesale, very reputable, highly account executive, and she's going to be breaking down some information for us in regards to FHA. That's going to be our focus and concentration. So take mental notes, grab a pen or a pad, paper, your coffee, water, things of that nature, okay? So, Wendy, let's start it off right now. One of the main questions that a lot of my homeowners or potential home buyers, we're going to start off with the purchase aspect of the market. They want to know what's the minimum down payment for first-time home buyers on FHA programs.
First-time home buyers or any FHA purchaser could do a loan at 96 96.5%, 3.5% down.
Three. Okay. So with that pretty much being said, do you still find it, I would say, beneficial with the recent changes with the upfront MI and the new monthly MI percentages? Should a homeowner, a potential prospect, look at that angle, or is it more accommodating to go with the conventional LPMI, which is the lender paid mortgage insurance on conventional loans?
The Federal Housing Administration, or HUD, offers these FHA programs to borrowers who have lower FICO scores. They do look at extenuating circumstances if you've had a foreclosure or a bankruptcy. So they allow you to have a 640 FICO score. We actually go down to a 620 and a 639, but that's different program parameters. But for all intents and purposes, 640 FICO score to get to 96.5%, especially for her first-time home buyer.
Right.
You also have a lot more right now rebate than you do on the conventional side. That wasn't the case until about 3 weeks ago,
Okay.
but it seems as though the YSP, yield spread premium, what's left over at that particular rate of a 4.375 rate, you'd have 4.5 points to pay for the upfront MIP, which we'll get into later, or the monthly MI, and your closing costs, and all kinds of other things. So the rates available are lower, and your FICO score can be lower, and the LTV is higher.
Okay, so it sounds to me, Wendy, to sum that up, is pretty much what the government is trying to do. They're trying to give potential home buyers more incentive and kickback as far as to allow the lender that's going to facilitate the transaction and or the broker a way to make it more cost efficient, logical, and beneficial to the client. And with that being said, you're still in favor with FHA. I mean, it's pretty much going to be one of those situations where you have to crunch the numbers.
Correct. I mean, if you wanted to have a cash-out refinance program to 85%, there's no one else that offers it, and up to $729,000, only
Right.
FHA offers that. So where you have upfront MIP and monthly MI that might be higher, you might not have a loan if you don't have enough YSP or a low enough rate for their debt-to-income ratio, or they had some foreclosures or bankruptcies that other people won't forgive. And we haven't even touched upon the non-owner occupant co-borrower where you can blend ratios yet.
Yeah, that's all factual. I mean, sounds like FHA is just a more liberal program altogether. What about down payments? I know there's a lot of speculation about if a gift, and you could explain what gift means for all the listeners out there and potential home buyers. Can gift funds actually be utilized fully? Can you receive a full gift for a down payment on a purchase on an FHA?
Correct. On the conventional side of loans, you can receive a gift, and as long as you are 80% or under, it can all be gift. But on the FHA side, even your 3.5% can be a gift from someone that you've known for a long time or a family member.
Mm-hmm.
They have to be someone that you have an association with, and they can gift you the funds where you don't need to repay it. I was even reading up before I went on the show, and you can have loans to get to 100% CLTV on the FHA programs, which thank you very much for making me do that because it reminded me of it, that you can take out a loan from a personal friend of yours or a father or a mother, and it can be a loan, and it can allow you to get to 100% CLTV if you needed to.
Right. The leverage is definitely there. And so with that being said, credit capacity, collateral is the three components that break down loans. Loans are based off of risk factors. So underwriters, usually they evaluate the risk, and they determine, what the maximum debt to income ratio will be allowable on this FHA product is the main concentration of focus right now. So what is the max debt to income ratio on FHA loans right now?
It is usually 50%. We have an overlay of 50%. But if you have compensating factors, if you have 3 months' worth of reserves left after you've closed the loan and brought in any assets that you needed to bring in, or if you had closing costs, if you have a FICO score over 680 and you meet two of these caveats that they have a little list of,
Right.
then you can go to a 55% debt ratio with us.
Right. And that's
And as far as the
go ahead, Wendy.
And as far as the lates go, you can have as many 30s as you want in the last 12 months, which is a little different from last week. But you cannot have any one-time 60s, and you have to be current as far as late payments on your mortgage goes.
Okay. And to simplify that, what Wendy is actually articulating, any 30s or 60s, meaning a 30-day mortgage late if you're over 30 days and you missed your mortgage payment, or if you have 2 consecutive months that you missed your mortgage payment. Mortgage jargon, we identify that and define that as 60-day lates. Very important verbiage you just used. You said compensating factors, and we want to enlighten, educate our audience in regards to compensating factors, because sometimes they could be a little discouraged as a deterrent, as far as, hey, you know, I may not be able to qualify, but that's the reason why FHA is in place to be as, I mean, it's almost as close as subprime, even though I don't like using that word, but it's almost as close to that we ever had. And with that being said, is you have compensating factors, assets, stability on the job, character, things of that nature. So the minimum FICO score on FHA, now I've heard, I know you're with Stearns, but I've heard you could go all the way down to 580. Does Stearns allow 580, or are we looking more at 620 FICO?
620, and the 620 to 639 program is a program in and of itself, and the 640 and above is the regular 96.5. You just have a few more restrictions. You can only have a 31 housing debt and a 43 back end. That means all of your other bills that you put together with your housing payment.
Right.
And on the regular side, when you have a 640 FICO score, you can go to the 50 or 55% DTI. Things like that would restrict it a little bit more on with our guidelines.
Right. Now, switching gears here, for all my listeners and audience, or if you have any friends or family that's currently already in an FHA loan, there's something that's very important, okay? If you're currently in an FHA loan, we're going to have Wendy explain the benefits of what a FHA streamlined loan actually means, okay? Wendy, can you take that? Can you answer that? I'm sorry.
Sure. FHA streamlines. If you currently have an FHA loan, if you have a loan that was an FHA loan and you like the lower rates, you want to take advantage of them, you want to do an FHA streamline, you do not have to have any income documentation.
Right.
You do not have to have an appraisal done. If you have over a 680 FICO score, we won't even do an automated valuation model. You can go based off of your old value on your old FHA loan. And if we can save you 5%, you can then save, $500, $600. I've seen them save quite a bit of money per month because they want to better the situation of those loans they have out there for those borrowers that they're already invested in.
I was going to say, so that's the stipulation. You need to at least have a 5% variance as far as a benefit for the loan to be approved for FHA streamline.
Correct. And if you've had a loan since 09 or before, May 31st, 09, Fannie Mae, Freddie Mac, and FHA all alike those loans because when they wrote those loans up, they weren't as particular as they are now. They've gotten a little stricter. So they're trying to clean up those loans off of their books. HARP 3 and other things might move that date forward.
Absolutely.
But right now, if you have a loan from 5/31/09 or before, you can then have, instead of the 1.75 upfront MIP, it would be 0.01 upfront MIP. Instead of the 1.30 or the 1.35 monthly for conventional sized loans under $417,000, you would have a 0.55 monthly MI instead of the 1.3 or the 1.35, which helps you to save that 5% and the hundreds of dollars in your pockets every month. So they are looking to better, again, the FHA loan consumer out there's position.
And that's a huge benefit. That's a huge benefit. So I know over at Malibu we're doing a lot of FHA streamlines. Once again, you could contact us at 888-713-2229. See if you could save that 5% variance. See if it actually makes sense. Because that's very, very powerful as far as if your loan was endorsed before June 1st, 2009, you do qualify for the grandfathered in lower MI and upfront MI. With that being said, so what's the current interest rates on a 30-year fix, 15-year fix, 10-year fix on FHA? I'm gonna give the listeners a little idea of why it's so powerful right now with the government loans, from the VA loans to the FHA. The rates are still in the 3% range, right?
Right, and they're not on the conventional side. When I was looking up something before, I saw that the 3 point, if we're going borrower paid, we're not going lender paid, we're going borrower paid loans when I'm saying these rates.
Mm-hmm.
It is 3.75 is showing me that we have 2 points left over towards closing costs. If you have a $400,000 loan, that means you have $8,000 left over for closing costs with those 2 points there, and you have some adjustments. But just straight off the rate sheet, 3.75 is showing 2.09. As with our conventional loans, the 3.75 wasn't even showing. The first time I got something on a conventional loan was 5.125, showing me 0.955. So the rates have really changed.
Mm-hmm.
With the MI, it wasn't so attractive. With the MI that stayed on for the life of the loan or 11 years, 90% or under LTV, which FHA just changed, it wasn't so attractive. But with the recent rate switch that's happened in the last 3 weeks,
Right.
FHA has again become more attractive because you can still build in your upfront MIP of 1.75, and you can finance it in a loan, or you could pay it off with the yield spread premium and have enough left over for your closing costs, still be in the 3% interest rate.
Right, right. So
range.
basically for homeowners would say a $300,000 loan amount, you have 2% left that the lender is going to give you towards incentive credit closing costs. That's about $6,000. So it is beneficial. It is still attractive. It does actually make sense. A lot of homeowners right now that are, say, lost one of their properties due to foreclosure, I mean, can they participate in the FHA transaction?
They can participate in the FHA, but they have to wait 3 years if they haven't approved eligible. The AU automated underwriting system puts in all of your information, puts in your credit history, your FICO score. It puts in how much assets you have in the bank that you can prove with none of those big deposits that you can't track,
Right.
over $1,000. All of that it takes into consideration, and it gives you an approved eligible or it gives you a refer. If you have an approved eligible, you need to have 3 years seasoning for a foreclosure.
Mm-hmm.
You need to have 2 years since a Chapter 7 discharge, Chapter 7.
Okay.
If you had a bankruptcy 13
Mm-hmm.
and it hasn't been discharged for 2 years, doesn't mean that you can't do a loan with us. The Chapter 13 is a different animal.
Okay.
It means that if you have a 12-month payment history with no late than a Chapter 13, you'd be downgraded to an automated underwriting system refer, and you could still do a loan as long as you had 12 months showing of no late payments on a BK 13. So it's 1 year for a bankruptcy 13.
Okay. And what about minor collections and judgments and things of that nature?
This is where they're very lenient, too, because collections and charge-offs don't need to be paid. There's no minimum credit. It's per the automated underwriting system's findings, so you don't have to have 3 trade lines with a minimum of 12 months on each trade line.
Okay.
You do, however, have to pay judgments and disputed accounts. If you're disputing an account or you have a judgment against you, those things do need to be paid off, but not collections or charge-offs.
Okay, so things like tax liens, student loans, that's mandatory. That's per guidelines. You need to pay that off.
Sure, a tax lien, they would be able to attach potentially the collateral that the lender has with this loan, and also if you have some other federal loans that haven't been paid off, I don't think the federal government's real happy lending you more money. So those would need to be paid off.
Absolutely. There's no such thing as free money to a certain extent, right?
No, there's not. But if you get yourself a good person, and that's why I'm so happy that this program is out there, too, that explains a little bit of what goes on in the loan business and all of the compliance issues that we have and the things that we have to adhere to, that someone can break it down for you. I've known Malibu Funding for 10 years, and I've referred a lot of people there. And that you have a program like this that explains it to them, and then they have people that can shop for the best, because there's MI on the conventional side, there's lender-paid mortgage insurance, and there's FHA mortgage insurance. And which one is best for you? How long do you want to keep your house for?
Absolutely. I mean, it's a very, very unique situation and a fortunate situation. I mean, we're excited over at Malibu Funding to be able to, reach the masses and utilize this platform to educate everyone, enlighten everyone. Because, knowledge is power. We all know that. You got to have the facts. And, without the facts, you may strategically make the wrong decision. So we're here to do the diligence for you. Now, with that being said, last question for you to wrap it up here as far as FICO scores. I know a lot of homeowners may be considered, let's say, I don't want to use the term a paper, but let's just say they have one FICO score and they're trying to rebuild their credit. Because usually people that paid off collections, has some BKs, judgments, things of that nature. Sometimes you pull their credit and they just have one score. What happens with that situation?
I can speak for what we do here. We need at least 2 scores. We don't need 3 scores from all 3 bureaus, but we need 2, and we take the lower of the 2. It used to be 6 months ago that you could take a co-borrower with no FICO scores and add them into the loan, but we now need everybody to have at least 2 scores. I have a little side note. If you have somebody that can be a non-occupant co-borrower and they're willing to go on a loan with you and they have 2 FICO scores at least, you could blend your ratios. You can take the money that they make and your debt-to-income ratio, you can use their money and both of your bills and see if your debt-to-income ratio can get to that 55% or 50% or lower debt ratio so that you would be able to qualify for the loan.
That's a very, very good point that you brought up. Is there any minimum to the amount of non-co applicants that could be on the loan? Is it 2? Is it 3? Is it 4? Is it?
You like to limit the number of borrowers to 4.
Okay.
So I don't think lenders like to see more than 4 applications. We call them 1003s.
Right. Absolutely. Wendy, tell everyone how they could get in touch with you, who you are, how long you've been doing this. What do you anticipate foresee as far, what's going on with the market, how the market has evolved? What's your 2 cents? I mean, you're highly knowledgeable and experienced and reputable amongst your peers in the industry with clients and everything of that nature. We want to know from you, what's your professional assessment of where the market is going, how it's evolving, and how can people reach out to you as far as other professionals, realtors, and things of that nature?
My name is Wendy Van Wessel. I've probably worked in the loan industry for a little over 10 years. I work at Stearns Wholesale Lending. I did 5 years of appraisals before that, so I know the appraisal end of things too and how it's changed with the AMCs, appraisal management companies, sorry. Where do I think the market is going? If I remember, Bernanke came out a couple of weeks ago, and this is just my opinion because if I had a crystal ball, I would be a millionaire. So I don't know exactly where the rates are going, but my opinion is that the market adjusted once when he said he was going to say something, when he breathed, and then when he said that they were going to be a little bit more particular about some of the things that they needed from their mortgage-backed securities before the banks bought them, they adjusted again, and they should have adjusted back down again, but they haven't. Everybody's up in the air. So the short-term bonds seem to be a better, they'll come back quicker than the long-term bonds.
Right.
So the mortgage-backed securities tend to be longer-term bonds. I don't know when the rates are going to come back. I wish soon, but I still think that they're lower than we'll see probably in the next 3 years.
Yeah, I mean,
they might dip down a little bit again, but just a little.
Historically speaking, we're still in a good place, right?
Yes. I believe we are, but I don't think that you want to sleep. You want to find out what kind of loan you can get and what position you can be in to better yourself. And there's a lot of exceptions in this FHA area, especially if you haven't touched your loan since '09. It would be a good time to do it now with that grandfathered in part of it. And as far as how they can reach me, you can always reach me at 310-457-4396. 310-457-4396 or wvanwessel@stearns.com.
Hey, Wendy, it was a pleasure speaking with you as always. Thank you for
Thank
all
you very much.
Thank you for all your experience and expertise, and glad you could be here today.
I look forward to hearing more of your show. Thank you very much.
No worries. So that was the great Wendy Van Wessel over at Stearns Wholesale. She's magnificent. She gave you all the information. As always, you can reach out to Malibu Funding at 888-713-2229. This is LA Talk Live, reality radio handcrafted for your listening pleasure. We're more than just talk. Stay tuned. I'll be right back with my next guest, Luke Manke.
We know there are many choices in internet radio, and the staff and host of LA Talk Live would like to thank you for choosing the internet's hottest destination for the most eclectic sound and invigorating talk. This is LA Talk Live. We are more than just talk.
Hey, shout us out. What's the count? I'm your host, Ferran Dozier. I'm inviting you to join me on WDC Radio every Monday at 11 a.m. Pacific Standard Time as we discuss community topics around health, sports, and entertainment. So don't forget to shout us out. What's the count? On WDC Radio, only on LATalkLive.com. You can also catch us on iTunes Radio, R&B, or watch us on Ustream.tv. Reality radio, handcrafted for your listening pleasure. This is LA Talk Live, and we're more than just talk. What's the count?
Hey, what's up? It's your girls, Forbidden Gems, inviting you to join us every Tuesday night at 9 p.m. sharp for the hottest, livest talk show, Forbidden Tuesdays.
Join us as we expose the new generation of love and dating and help y'all run the game right. Ladies beware, fellas bring out your notepads.
So don't forget to tune in to
Forbidden Tuesdays
exclusively on LATalkLive.com. You can also catch us on iTunes Radio R&B or watch us on Ustream TV. This is
LA Talk Live,
and we are more than just talk.
You ready?
Welcome back to the Mortgage Show every Tuesday afternoon, 3 p.m. This is our official show. Last week was the pilot show. Hopefully, all my listeners and audience are actually taking some mental notation here, mental notes, and getting some facts. Well, we're going to switch tunes. We're going to switch gears here again. And I'm pleased to have on standby Luke Manke. He's actually a broker affiliate with Malibu Funding. He's been in the industry for a very long time. Luke, are you there?
Yes, sir. How you doing, Brass?
Luke, I'm doing well. You're staying cool over there, Luke? It's pretty hot out there.
I'm trying. We're doing all right, but the AC's pumping today.
AC's pumping. We're officially in summer, and the market is hot. Market may be a little hotter than the weather. So, Luke, let's start off in perspective as far as interest rates rising. I really want to hear your perspective on interest rates right now. For all the listeners, we're switching gears and we're going to talk about conventional financing, A-paper. And Luke is going to break down what the A-paper really actually means when we use that verbiage, when we use that term. Remember, I was talking about the 3 C's, credit, capacity, and collateral. Credit is your FICO worthiness. Capacity is how much money you make, your debt-to-income ratio. Collateral is the equity in your property. Loans are based off a risk factor. Where do you see interest rates going right now? What's your perspective on that?
Well, I like Wendy and everyone else. I'm hoping that they trend down and we get a little bit of correction here. But it's really tough to estimate and really gauge how it's going to happen. I can tell you one thing for sure is this market, everyone got burned. Nobody, not very many people saw, end of 2007 and 2008 coming, and everybody kind of got burned, and they got caught by it, unprepared. And so now everybody overreacts. They really have a tendency to, as soon as anything, something bad may not even happen, but with just the Fed saying, we're going to taper off on this QE3, we're going to stop, buying some of these mortgage-backed securities. We might buy a little bit less in the start of 2014. Just that threat causes, utter chaos and panic throughout the market. So everybody raises their rates for right now, not necessarily a good reason. It's a little bit premature, but it's happened, and we're all kind of caught here trying to repair and adapt and make the best move. And I don't know. I know that if it comes back down, I don't think it'll last very long because long term, just like Wendy said, I think within another year or so from now, year and a half, I'm sure we'll be in the 5s, if not sooner. Maybe we might be in the 5% range by the end of the summer, by the way things are going.
It sounds like the joint consensus around the industry is basically it's time to move. You may have been on the sidelines. Everyone was trying to decipher whether or not it made sense, but I guess the common denominator is when prices rise, interest rates rise. So it's time to make a move. What are you pricing out right now on your A-paper clients on conventional? What interest rates are you seeing? What are you actually pricing out with current homeowners right now?
What we're pricing out, currently today, as you guys were discussing, I think that, that 4.125 to 4.375 is your range. today. Today is actually a little bit better. Today and yesterday are a little bit improved from Wednesday, Thursday, and Friday of last week. We were, right at 4.5 in the middle of last week, so we've corrected maybe 0.25% down on a 30-year fixed. 15-year fixed today, you're ranging between 3.25 and 3.5. Mm-hmm. And that's kind of what we're seeing with the A paper.
So what's the benefit, Luke? We were talking about FHA, so we know FHA has a lot of benefit, a lot of incentive compensating factors. But on the conventional side, what's the benefit conventional product versus FHA? What's the pros of the conventional product?
There's a lot of pros. There's a lot of pros of each. FHA can definitely help somebody get into a home a lot easier. It's going to cost you more, but hey, there's not a lot of products where you can bring a couple family members on to help qualify, come in with 3.5% down and get in the home. I mean, it's an incredibly aggressive product, but it's a little more expensive. Your rates are lower, but the mortgage insurance is higher. With conventional loans, you can do something. Heck, there's even a 3%, but really you want to keep in the mindset of if you have 5% down, you can get into a conventional loan, and you're going to pay less mortgage insurance on a monthly basis. You don't pay it up front. As you guys discussed earlier, you're going to pay, the homeowner is going to pay 1.75% on your standard FHA loan. So I don't know, like rough figures on a $300,000 loan or a $300,000 purchase price, you're going to spend to the tune of $5,000 or a little bit more just in upfront mortgage insurance premium, and that's essentially a donation to FHA. And then on that similar structure, purchase price, you'd be paying about $3.25 or so a month on monthly mortgage insurance. So $325 a month in MI. On the exact same loan with 5% down on a conventional loan, you'd be paying about $250 a month. So you're saving $75 a month on the same type of loan by going with a conventional loan, and then you're also not paying $5,000 in upfront mortgage insurance premiums. So those two right there. Go ahead. I'm sorry.
It sounds to me that in addition to what you're saying, and I confirm all that what you're saying, I agree with you 150%. Is conventional loans are less stringent as far as the underwriting process than FHA, right? The underwriter will not scrutinize the file as hard, correct?
Yes, that's absolutely correct. Whether it's bankruptcies, whether it's credit depth, debt-to-income ratio, you can go up to 56% potentially on FHA. Conventional, it ranges between 45 and 50 typically. Really strong, as you guys said, compensating factors. If you've got good assets, great credit, good credit depth, long time on the job, then you could get up to 50% DTI. But that's still not 56 DTI that you get on an FHA loan. But I'll tell you, I advise my clients as well. Yes, you can get higher debt, you can have less income, you can get higher DTI approved, but then you're paying more monthly mortgage insurance. So I really dig in and try and, if I at all possible can get my client in a conventional loan, it's cheaper for them. I'm not going to make as much on it, but it's not really about me. It's about trying to get the client in the best loan and the cheapest loan and maybe pre-qualify them for the highest possible purchase price. And if you really dig into it, which I try to do on all my loans, there's definitely ways to get them into this, top tier loan, which is what a conventional loan really is.
So as far as documentation, what would you suggest potential homeowner to have as far as personal documentation ready to provide for the lender? A lot of it is the process. A lot of people, once again, were standing on the sidelines and they missed the 3% range because, they told me, look, I don't like the process. I don't want to go through the process. I don't want to gather my documentation. I don't want to gather my paperwork. The market is switching, yada, yada, yada. And we know here at Malibu Funding, the best thing that, we present to our homeowners is service. That's the first thing. We know it's all about service, right? So besides being competitive as far as the price point with the interest rates, the process and everything like that, can you just simplify to homeowners how easy it is? I mean, what is necessary in order to submit your documentation for a loan?
You're absolutely right. I mean, and it's not the days of stated. You just provide your address, where you work and just we'll stay what you make, and that's it. Maybe we'll give you your asset account, and that was all we needed back
The
prior
good
to
old days, huh? The good old days.
Yes, the wild, wild west, as I like to refer to it as. But nowadays, it's a little more. It's a lot up front, but, I just always hit my clients with the full list of everything that I want up front, and you just knock it out. And the first, it takes you a day or so to gather everything, and then it's smooth sailing from there on out. And really, it's all of your income doc. So ideally, I'd like your last 2 years' tax returns. If you're a salaried employee, then I want your last 2 years' W-2s and a recent pay stub. If you're self-employed, then I'd like 1099s, or if you have corporate returns, then I want those as well as your personal tax returns. And then for those people that might be retired or on disability, it's helpful to have your Social Security and pension award letters so that we can prove that income as well. And then really on top of that, it's just, ideally it's nice to get an asset account, so we get an IRA or some sort of a checking or savings account, and then mortgage statements, homeowners insurance, driver's license, and Social Security card.
So,
sounds like a lot, but really it could just take you a few hours. Or a call to your CPA.
See, good point, Luke. Good point. I mean, that's something that we want to stress is, sometimes you're trying to put your finger on the tax returns, your 1040s, and you have guys, hey, my taxes, my 1040s, my 1120s, all my schedules. We're looking at 200 pages. Usually, if you contact your accountant or your CPA, they could email that stuff via email, and it's on PDF. Correct?
Perfect. That's exactly what I tell all my clients. So it's so much easier that way.
So much easier.
You're paying your CPA, so why not hit them up for it? They have it all on e-file on their computer. So
now, is this a rumor, or is the 1 year tax return program actually slowly making its way back with the majority of your lenders? I know it's per desktop underwriting findings, the automated underwriting system, but if you can elaborate and explain some of the benefits and details, what that actually mean when the lender says we will accept only 1 year of your tax returns for qualification purposes, because I think that will alleviate some of the pressure and tension on some potential homeowners.
Yeah, absolutely. It's not, we're so trained to just get 2 years that we typically get 2 years, and probably, 9 out of 10 of my files that I submit, I just get 2 years income, and I don't even care what DU gives us. But there is that specific buyer or borrower that only can or wants to provide 1 year income doc, and you can, just like you said. We put together an application and we run Desktop Underwriter, Fannie Mae's automated underwriting system, and it gives findings for us. And if it gives us a 1 year income doc finding, then we can abide by that, and that's all we have to provide the lender. And I'll tell you, when it works, it is a beautiful thing, because you get people. I've had a couple of these recently. One was a student that got her master's, and she couldn't get hired out of school, so she worked for her parents, and they paid her cash for a year, and she couldn't get hired, so she went back to school, got further degrees as well for 2 years, and as soon as she went back in for further schooling, she got hired. Well, she didn't have 2 years of employment. She just got hired a few months prior, and she didn't have a tax return prior to 2012. So she had she had good credit. She was coming in with a solid down payment, and we got DU to give us a 1 year income doc finding. And if it required 2 years, I wouldn't have had a loan for this girl.
Exactly.
So it can be a really helpful product. So yes, that is out there. That product is out there for the public.
So what should potential homeowners or a current existing homeowner actually consider when they're in the process or going to be in the process of applying for a mortgage? I mean, what would you tell them, Luke, as far as initial preparation? I mean, the do's and don'ts, because there's a lot of things that can sabotage your finance transaction. I mean, it doesn't matter what income bracket you're in. You can't go out there and go on a $10,000 Nordstrom's shopping spree in another country. You can't go out there and buy a new car and things like that when you're in the process of a finance transaction. I mean, what can you elaborate on that aspect of it?
Yes, you have to be disciplined, just like you said. Buying a new car, taking a lease on a new car, running up your credit cards either close or exceeding the balances. Ideally, you want to be like 33% is kind of the industry standard for. You want your credit card balances to be ideally no more than 30% of their maximum limit. So you want to try and keep your credit card balances down. Don't go out and open up a couple new ones and do a bunch of balance transfers. All that kind of activity causes inquiries on your credit report. And the more inquiries, the more activity on your credit right before trying to do a refinance or purchase is really going to have ill effect on your credit scores and might be the difference between whether or not you qualify or you don't qualify. I think it's also good. You want to be disciplined with work. Ideally, you want to, ideally 2 years, but even if you just get hired on a job, you don't want to make any different career moves or anything drastic. We've had people in the past that just, I decided to quit. Well, we're trying to fund your loan in a week from now, and
right.
You just decided to quit. You didn't think we needed your employment. So, just slow and steady and no drastic moves, and everything should be fine.
Right. I mean, in essence, we always have to expect the unexpected because, human nature, tendencies, people want what they can't have. They may not be disciplined, is what you said. Very important case, but just in case something of that nature does evolve or materialize, I know you do it as well, and I do it as well. We pretty much will be able to deal with that hands-on, and if that does happen, we could basically do something called a rapid rescore and walk you through the process and that's part of the service aspect of it, where we'll be an intimate transaction, different than if you're walking into a bank on the retail side. And that's the benefit of dealing with a broker, would you say, Luke, is we are more personable. It is a more intimate transaction. And when things of that nature does arise, we're pretty much there every step of the way, correct?
Yeah. We're more educated. There's far more requirements for licensing, both on the federal and state platform. You're going to find a more educated, dedicated, intelligent person typically on the broker side. I can't speak for everyone, but just most of the people that I come across in the business, everyone that's on the broker side, they just care more. It's a career. Like I'm not, anyone can go get hired and sit in a bank and wait for somebody to come in. And if it doesn't work out on somebody, then somebody is right behind them coming in again. Whereas with me, I value and strive for referrals, and I got to take care of everyone like it's my own baby and see it through to the end and fund it. So you're just going to see a much higher service level from a mortgage broker.
You know what? Let's touch on, and this is something that I believe it was the Dodd-Frank bill that I want to talk about. The HVCC regulations, when that was implemented with the appraisal process, a lot of homeowners are confused with the process now because they think you could still call your buddy down the street that you have a relationship with and hit a certain value because you need a certain loan to value to make the loan work. But now there's appraisal management companies that's in place where the lender actually hires a third party to appoint someone, and they go out there. Now the broker can't talk to the appraiser. Can you touch on the whole HVC regulations and in your personal, or I should say your professional opinion? Do you think that's ever going to get overturned?
Boy, yeah. They enacted this back in 2008, and it was the problem of brokers and bankers having a friend as an appraisal, telling him I needed a certain value to make this loan work, and the appraiser would do everything they could to try and bring in the value, sometimes very recklessly. And so that was one of the many contributing factors to just the inflation of values and this bubble that we built. So they created this home valuation code of conduct, and it requires these third-party appraisal management companies to handle all the order and dispatching of these appraisers. So it's just a totally uninterested third party. When a refinance or a purchase appraisal gets ordered, it gets ordered, and then there's a key, and they dispatch a local appraiser for that neighborhood, and they do the appraisal and send it back to the lender, and that's it. It's illegal for the loan officer or the broker to contact them. We have no way of getting any comp check. Honestly, it forces us to be a little bit more in tune with the values of the area and do a very thorough comp check on our own because we're playing with our clients' money. They have to pay the $450 or sometimes more dollars for the appraisal before the loan closes. So we need to be very thorough looking at market trends and values before we place that order for them. So that's kind of what this has created. It's definitely more conservative. There's a lot of negatives to it. You definitely get some values that come in that are quite unpredictable and sometimes laughable, but for the most part, I can see the benefit of it. I hope it eases up a little bit later on, but gosh, I mean, we've all adapted, so it's just one more thing down the pipe that they've given us, and we've all adapted to it. We have to.
Right. There's nothing wrong with diligence, right? To make sure that the loan is actually going to go through. So it's another deterrent, but at the end of the day, it just puts you on the front line to make sure that you're going to get the best deal and the best transaction for the homeowner. Since we're talking about equity, let's, on a positive note, if you do have equity in your property and someone out there is listening and they do want to restructure and leverage their mortgage for benefit, what's the max loan of values right now with pulling out cash out refunds?
For cash, I think you guys might have mentioned it earlier, but with FHA, it's just 85% across the board. The nice thing with FHA, one of the many niches with that product is you can pay off debt to qualify as well. But you can do an 85% LTV cash out on FHA, and then if you're under that conforming loan amount of 417, if your loan amount's under 417,000, then you can do 85% LTV.
Okay.
On that, and then you're looking on second homes and non-owners, you're looking at 75%. It's lower if your loan amount's between 417 and 625.5, then you're looking at like 60% on a Fannie Mae loan, 75% on a Freddie Mac loan. So those are much reduced if you're in the high balance loan amount sector, but still not bad. And as values increase, I think that's definitely going to be something that people are going to start looking at is, tapping into that equity to do home improvements, to reinvest in another property. Who knows, pay for a wedding.
Exactly, Luke. I like to say thank you, Luke, for your time and your patience and your knowledge and your expertise coming on live here today at LA Talk Live on the Mortgage Show with Burness Heron. That's my special guest spot, Luke Manke over at Malibu Funding. Luke, how can everyone get a hold of you?
Thank you, Brenna. You can get a hold of me always directly at 818-209-2592, and that is my cell phone. And my email is Luke, Luke, .malibufunding, all one word, at yahoo.com. Luke.malibufunding at yahoo.com. And I appreciate the time. I really, this is a great show, and I'm happy to help.
Thank you, Luke. We're going to take a quick break, and I'll be right back here at the Mortgage Show, LA Talk Live, where we're more than just talk. Reality radio, handcrafted for your listening pleasure. Talk to you soon.
Thank you for tuning in to LA Talk Live, reality radio, handcrafted for your listening pleasure. This is LA Talk Live, and we're more than just talk. Stay tuned.
Hey, what's up? It's your girls, Forbidden Gems, inviting you to join us every Tuesday night at 9 p.m. sharp for the hottest, livest talk show, Forbidden Tuesdays.
Join us as we expose the new generation of love and dating and help y'all run the game right. Ladies beware, fellas bring out your notepads.
So don't forget to tune in to
Forbidden Tuesdays
exclusively on LATalkLive.com. You can also catch us on iTunes Radio R&B or watch us on Ustream TV. This is
LA Talk Live,
and we are more than just talk.
You ready?
Welcome back to the Mortgage Show every Tuesday at 3 p.m. Pacific here at LATalkLive.com. You could also tune in and catch us on iTunes Radio R&B, Radio Flag, Live 365, and any of our global affiliates Ustream as well. So today we learned a lot. We talked a little about FHA, the pros and cons with the new mortgage insurance, the upfront MI versus the monthly MI. We also talked about streamlined, more liberal transactions such as conventional loans. At the end of the day, the bottom line is if we can meet your wants, your needs, and your desires, please give us a call at 888-713-2229, 888-713-2229, and we are basically here for all of your questions. What I want to do right now is switch gears and talk about the next topics for next week's show. After the holiday, we'll come back, and then the next show, 3 p.m. Pacific Standard Time, as I stated, we're going to be talking about reverse mortgages. Okay, so if you know anyone that's elderly, I should say, or retired, of that nature, I believe it's 63 years of age, 63, 64 and above, they would qualify for reverse mortgage. It was a scary topic for a while. It was kind of taboo. But now, with more people retiring and things of that nature, and Social Security potentially going away, and people's pensions have been decreased, and things of that nature, more and more seniors are starting to take a look at reverse mortgages, and they're actually motivated and intrigued. And it's a taboo subject, but once again, we're here to simplify it through Malibu Funding, and we're going to have a special guest host, Tim Grayson. We also have another expert on reverse mortgages, Brent Gong. He's also a broker with Malibu Funding. He'll be here to break down and give you all the facts. And then switching gears, staying on that, switching gears out of that topic, we're going to go back to government-type transactions for all the veterans out there, what VA loans are. So VA loans, once again, you could go up to 100% financing, and even on some VA loans, you could go up to, I believe, 110% loan to value. So that's on the refi aspect. But for the purchases, you could go up to 100% financing. So if you know any veterans, and veterans doesn't absolutely mean that, it's a older gentleman or a woman. I mean, there's a lot of younger VAs that, went out there and served the country, fighting. It's only fitting we do that show after, the 4th. In honor of our vets. So that's going to be a really, really good show to break down and give you some facts and things of that nature. One of my favorite programs besides FHA Streamline is the VA program, Streamline program, because once again, there's no appraisal needed. And there's no income verification or anything of that nature. So it is a true streamline. You just have to make sure that you have the verification, that you are a vet, and you've never taken advantage of the program before. And that on a purchase side, on a refi aspect, you could do it as many times as you wish, as long as there's a benefit in it and it actually makes sense. So obviously there's certain FICO parameters. And, one of the main things is you still can't have any mortgage lates. You still have to maintain your credit worthiness as far as your verification of mortgage, no lates. So let your friends and family know about the next show next Tuesday at 3 p.m. Pacific here at LA Talk Live, talking about reverse mortgages, talking about veterans loans. It's always been a pleasure. And what I want to basically do is find out from any of my listeners and callers. You could always reach out to us via email. You could call in and let me know what you think about the show. Give me some feedback on Twitter, on Facebook, whatever the case may be. Maybe you have some topics. Maybe you have some questions. What I want to try to do eventually, maybe in the second or third show, is transition into an open call, here in the studio, as far as what the public is thinking. I want to gauge the temperature of the environment, what's out there, so I can make sure we touch. There's no subjects, no topics off limits. We want to make sure that we basically are able to give you all the facts and tell you exactly what we're doing. Because what we're doing over at Malibu Funding, we're doing a lot of things. I mean, the bottom line, the difference between a broker on a wholesale side and a lender is we just have more options. We're going to exhaust every avenue. We deal with over 30 investors, and we're going to make sure that we find the best loan for you and your family. And the best thing about it is, I was talking about being liberal versus stringent and things of that nature. Whatever your situation is, we're going to make sure that we go to bat for you. And rates are pretty competitive right now. And I think everyone was spoiled on the sideline, and that's why I was asking Luke, and I was talking to Wendy and say, hey, what's your perspective? Because as Wendy stated, no one has a crystal ball, but this is the time for everyone that can take advantage of the market, okay? Once again, thank you for tuning in, joining in. I'm going to go enjoy my holiday. Hopefully you enjoy your holiday. Thank you for being here. You're listening to The Mortgage Show with Bernice Heron at LA Talk Live, where we're more than just talk. God bless. I see you next week. Take care.
We know there are many choices in internet radio, and the staff and host of LA Talk Live would like to thank you for choosing the internet's hottest destination for the most eclectic sound and invigorating talk. This is LA Talk Live. We are more than just talk.